There is a mechanism running underneath the global financial system right now that most people have never heard of. It has been quietly powering markets for decades. Trillions of dollars depend on it every single day. And right now, for the first time in a generation, the conditions that make it work are breaking down simultaneously from three different directions. When this mechanism reverses, and the signals that it is beginning to reverse are already appearing, it will not just affect stocks. It will not just affect bonds. It will trigger a liquidity shock that moves through every asset class, every settlement system, every cross-border payment corridor on Earth. Trillions of dollars will need to move, fast, through whatever infrastructure can handle them. And here's the part nobody in mainstream finance is saying out loud. The settlement infrastructure that currently exists was not built for this. It was built for a world where transactions settle in days, where pre-funded liquidity buffers absorb the lag, where correspondent banking relationships manage the friction. It was not built for a world where $2.3 trillion in foreign-held U.S. treasuries potentially needs to shift in a compressed time frame while geopolitical tension is simultaneously spiking oil to historic levels. But there is infrastructure that was built for exactly this. Infrastructure that settles in seconds. Infrastructure that operates 24 hours a day, 365 days a year, without pre-funding requirements, without correspondent bank intermediaries, without the settlement lag that turns a liquidity shock into a systemic crisis. And the name of that infrastructure keeps appearing in the same conversations where the world's most important financial institutions are quietly preparing for what comes next. Welcome back. I'm the calm analyst. Today we connect the dominoes. Let's go. Let's start with the mechanism itself, because most people have encountered the phrase carry trade without ever having it explained in a way that makes the risk legible. For decades, Japan has maintained interest rates at or near zero. That policy was designed to stimulate Japan's domestic economy, but it created a side effect that became one of the most powerful liquidity engines in global finance. It gave sophisticated investors access to essentially free money. Here is how the trade works. A hedge fund, an asset manager, a sovereign wealth fund, any large capital allocator, borrows Japanese yen at near zero cost. They convert that yen into dollars, euros, pounds, or any higher yielding currency. They invest those converted funds into U.S. treasuries, global bonds, equities, real estate, emerging market assets, anything generating a return above the near zero borrowing cost in yen. They pocket the spread. They repeat the trade. They scale it. Over time, this mechanism grew to encompass trillions of dollars in global capital. Analysts estimate that approximately $2.3 trillion in foreign-held U.S. treasuries alone are connected to carry trade positioning. That number does not include the equity exposure, the real estate exposure, the emerging market debt. The full scale of capital that has been deployed using cheap yen as its funding vehicle is a number that is difficult to calculate precisely. But the directional reality is clear. It is one of the largest single liquidity engines in the history of global finance. And here's the trap built into every single carry trade ever constructed. The trade only works as long as Japan keeps rates near zero. The moment the Bank of Japan raises rates meaningfully, the moment the cost of borrowing yen rises, the math of the carry trade breaks. Investors need to unwind. They sell whatever they bought with the borrowed yen. They convert the proceeds back into yen to repay the loans. And they do it fast, because everyone in the trade is watching the same signals and moving toward the same exit simultaneously. That is the reverse carry trade. And when it happens at scale, it does not look like an orderly rotation. It looks like a global liquidity shock. Now let's run the math on what the current environment means for that mechanism, because the pressure points are stacking in a way that has no recent historical parallel. The first domino is oil. The Strait of Hormuz, the narrow passage through which roughly a quarter of the world's oil shipments move, is under disruption pressure from the current Iran conflict. Oil supply shocks of this magnitude are historically rare. The supply shock currently unfolding is approximately 10 times the size of the 2022 Russia-Ukraine event, which itself sent oil from $70 to $130 per barrel. Current prices have already hit levels not seen in years, and economic models indicate that sustained levels here will reduce U.S. GDP growth by approximately 0.5%, equivalent to roughly $160 billion in lost economic output. But the oil story is not primarily a US story. It is a Japan story. Japan imports nearly all of its oil. When oil prices surge, inflation in Japan rises directly and rapidly. That inflation creates pressure on the Bank of Japan to raise interest rates to stabilize the yen's purchasing power. And if the Bank of Japan raises rates meaningfully, even a modest increase from near zero, the carry trade math breaks. The second domino is interest rate divergence. The Federal Reserve has maintained rates at elevated levels relative to Japan's near-zero policy. That spread, the difference between what you earn deploying capital in dollar-denominated assets and what you pay borrowing in yen, is what makes the carry trade profitable. If Japanese rates rise while US rates hold or fall, the spread compresses. The profitability of the trade compresses. The incentive to maintain the carry trade position weakens, and when incentives weaken, positions get unwound. The third domino is geopolitical uncertainty. Global uncertainty indices are currently sitting at levels described as the highest ever recorded, above COVID, above the 2008 financial crisis, above the dot-com collapse. When uncertainty spikes to these levels, risk appetite collapses. Carry trades, which are fundamentally bets on stability, on the continuation of existing rate differentials, on calm, predictable markets, are the first casualty of extreme uncertainty. They get unwound not because the math changes, but because the confidence required to maintain them disappears. 3 dominoes. Oil pressure forcing Japanese inflation. Interest rate divergence compressing the carry trade spread. Geopolitical uncertainty destroying the confidence that makes the trade viable. All 3 are active simultaneously right now. And when all 3 align, $2.3 trillion in foreign-held US Treasuries, plus the full scope of global equity, bond, and real estate exposure funded by cheap yen, starts moving. Fast. Looking for somewhere to go, through whatever settlement infrastructure can handle it. Here is where the story shifts from macro crisis to XRP thesis, and where most analysts stop making the connection clearly enough. When carry trade capital unwinds at scale, it is not just an investment event, it is a settlement event. Trillions of dollars need to cross borders. They need to convert from one currency to another. They need to settle between counterparties in different jurisdictions with different banking systems and different regulatory frameworks. And they need to do this under conditions of maximum market stress, when traditional settlement infrastructure is most likely to fail, most likely to be congested, and most likely to impose the kind of delay and friction that converts a market adjustment into a systemic crisis. The correspondent banking system, the infrastructure that currently handles most cross-border settlement, was not designed for this scenario. It operates on settlement windows measured in days. It requires pre-funded Nostro accounts in every corridor. It depends on a chain of intermediary banks, each taking a fee and adding latency. Under calm conditions, this system works passively. Under a $2.3 trillion liquidity shock, it becomes a bottleneck. Former CFTC Chairman Christopher Giancarlo identified this dynamic precisely when he stated that banks need crypto regulatory clarity more than crypto companies do. His reasoning was direct. Traditional financial institutions know their payment infrastructure is outdated. Cross-border transactions still take days. Settlement systems require massive pre-funded liquidity pools. During periods of financial stress, those inefficiencies become catastrophically expensive. Banks want the ability to integrate blockchain infrastructure because when global liquidity shocks occur, they will need faster rails to move capital. That statement is not coming from a crypto advocate. It is coming from a former regulator who spent years at the center of the traditional financial system and watched it operate under stress conditions. His conclusion is the same conclusion that Ripple has been building toward for over a decade. The rails that can handle the next liquidity shock are not the ones that handled the last one. XRP was designed specifically to be the neutral cross-border settlement currency for exactly this scenario. Not for calm markets, not for routine payment processing, for the moments when capital needs to move fast across borders without pre-funded buffers, without correspondent bank intermediaries, without the settlement lag that turns friction into crisis. The demand for that infrastructure does not emerge gradually. It emerges in shocks. And the conditions for the next shock are assembling right now. Now let's stack the institutional evidence, because the domino theory is not just a macro argument. it is being validated by the specific moves that institutions have been making quietly for years in preparation for exactly this scenario. 1,700 NDAs. That number emerged from the Ripple versus SEC lawsuit discovery process. 1,700 non-disclosure agreements signed by parties that Ripple had engaged with commercially. The names behind those NDAs were not disclosed, the banks were not named, the governments, if any, were not confirmed. The institutional partners that have been testing, deploying, or integrating Ripple's infrastructure at a scale below public awareness remain unknown. Think about what that number means structurally. The publicly confirmed partnerships, Royal Bank of Canada, Bank of America, Bank of Tokyo Mitsubishi, Santander, Standard Chartered, CIBC, Westpac, MasterCard, the DTCC through Hidden Road, TCS banks, represent a fraction of the full picture. 1,700 NDAs, 1,700 parties that signed legal confidentiality agreements to protect commercially sensitive information about their relationship with Ripple. Brad Garlinghouse described adoption not as a single ribbon-cutting moment, but as thousands of switches turning on across the financial system. Individually, each switch seems small. Collectively, when enough switches activate simultaneously, the effect becomes overwhelming. The infrastructure rollout is not designed to be visible until it reaches scale. That is not a failure of transparency. That is how institutional infrastructure deployment works. Companies do not announce live production systems until they are ready to support the volume those announcements will attract. The 1,700 NDAs represent 1,700 switches that have been wired in, but not yet publicly flipped. Some of them may already be live at low scale, processing volume that has not surfaced in any public announcement, testing corridors that will become high-volume routes when the macro conditions that require them arrive. When those conditions arrive, when the carry trade reversal sends trillions in capital searching for fast, neutral, cross-border settlement infrastructure, those switches do not turn on gradually. They turn on under the weight of the liquidity shock itself. And the network effect of 1,700 institutional relationships activating under crisis conditions is not a linear addition of volume. It is an exponential multiplication. Here is the catalyst sequence that connects everything, because timing matters and the sequence is tightening. The Clarity Act is in final congressional negotiation with White House support and bipartisan backing. When it passes, every U.S. institution that has been maintaining its Ripple relationship under NDA, unable to go public due to regulatory uncertainty, gains the legal framework to announce and scale. 1,700 switches suddenly have the green light to flip publicly. The DTCC tokenization service launches in the second half of this year. When institutional assets begin flowing through tokenization infrastructure connected to the XRP ledger through Hidden Road, the settlement volume on the ledger scales in a way that creates immediate real-world validation of the liquidity infrastructure thesis. Oil prices remain elevated, with geopolitical conditions making a near-term resolution uncertain. Pentagon planning scenarios include conflict timelines extending into September. Every week that oil remains elevated is another week of inflation pressure building in Japan. Every week of inflation pressure in Japan is another week of pressure on the Bank of Japan's near-zero rate policy. Every week of pressure on that policy is another week that the carry trade unwind moves from theoretical to imminent. These three timelines, regulatory clarity, DTCC deployment, and carry trade pressure, are running in parallel right now. They do not need to align perfectly. Any one of them accelerating faster than expected creates conditions where the others are pulled forward as well. Regulatory clarity accelerates institutional deployment. Institutional deployment validates the settlement thesis. Carry trade stress creates demand for the settlement infrastructure that has been deployed. Demand drives volume. Volume drives the supply-demand dynamic of a fixed supply bridge asset. The dominoes are lined up. The first one is already moving. I want to speak directly to the frustration that a lot of people are feeling right now, because this is a moment that tests conviction in a very specific way. The macro picture I have just described sounds bearish on the surface. Oil shock, carry trade unwind, global uncertainty at record highs, stock futures opening down. These are not comfortable conditions. And in the short term, the selling pressure from carry trade unwinding hits risk assets, including crypto. That is real. But here is the distinction that separates the informed from the reactive. Short-term selling pressure from carry trade mechanics is not the same thing as the long-term structural demand signal changing. When carry trade capital exits risk assets, it is not exiting because XRP's utility changed. It is exiting because the funding vehicle that brought it in is being recalled. That is noise generated by the mechanics of the old system unwinding. The signal is what comes after the unwind. When trillions of dollars in global capital need to find new homes, when cross-border settlement demand spikes, when the institutions that have been quietly building on Ripple's infrastructure for years find themselves operating under exactly the stress conditions that infrastructure was designed for, the switching moment arrives not as a scheduled announcement, but as a necessity. The silence before that moment does not mean nothing is happening. It means the system is loading. 1,700 NDAs are loaded. The DTCC deployment is loading. The Clarity Act is loading. The carry trade reversal is loading. You are watching the pre-activation state of a network that was built for exactly this environment. Being early in a structural transition feels exactly like being wrong, until the transition arrives and the people who were early are the ones who were right all along. Here is what I want you to carry forward from everything we covered today. The yen carry trade has powered global markets for decades using borrowed Japanese yen deployed into higher-yielding global assets. Japan's near-zero rate policy is the foundation of that system. Oil prices spiking to historic levels are creating inflation pressure in Japan, which imports nearly all of its oil, that may force the Bank of Japan to raise rates. If that happens, $2.3 trillion in foreign-held U.S. treasuries, plus trillions more in global asset exposure, begins to unwind. Fast. That unwind is a settlement event. Trillions of dollars crossing borders simultaneously under maximum market stress through infrastructure that was not built for it. Former CFTC Chairman Giancarlo stated directly that banks need crypto regulatory clarity more than crypto companies do, because they need faster rails for exactly this scenario. XRP was built for exactly this scenario: neutral, cross-border, instant, without pre-funding requirements, without correspondent bank intermediaries, designed for the moments when capital needs to move fast and the old infrastructure becomes the bottleneck. 1,700 NDAs, thousands of switches wired in but not yet publicly flipped, the DTCC deployment loading, the Clarity Act in final negotiation, the carry trade domino already beginning to move. Brad Garlinghouse said adoption will not be one ribbon-cutting moment. It will be thousands of switches turning on, and when enough of them turn on simultaneously, when the macro conditions that require them arrive at the same time the regulatory conditions that permit them clear, the effect does not accumulate gradually. It arrives all at once. Comment domino below if you made it all the way through this analysis. I want to see who is watching the right system, not just the price chart. Stay patient, stay rational. The dominoes are already lined up. The first one is moving. Most people will not understand what is happening until it is already done. We don't wait for the future, we plan for it.